Welcome back to Good Revenue. Today we're going to share the first half of a recent interview that we did with Michael Frankel of Trajectory Capital. It's a really interesting conversation about the state of M&A and some predictions for 2025 and beyond. Thanks for listening. Welcome back to Good Revenue. We are here today with Michael Frankel, founder and managing partner of Trajectory Capital. Michael, we're so happy to have you back on the show.
I'm glad to be back. Thanks for having me.
It's a pleasure. What a year it has been. We had an incredibly significant election here in the United States. We're seeing stock market highs. We're hearing threats of global trade wars. We're into charted global instability or massive change, depending on your perspective. At the same time, it's been a really interesting year for M&A in that the global M&A market has also recovered quite a bit. BCG released its 21st annual report a couple months ago, and they showed a 10% increase in deal value in the first 9 months of the year. We're reaching the all-time market high of 45,000 deals. What's your sense of the state of the world?
It's a intellectually interesting and yet financially scary time because so much is uncertain and uncontrollable. And so it's so hard to at least make short-term or even medium-term bets because there's so many unknowns, right? As you pointed out, we're going to have new political leadership in January. We have a whole bunch of different potential policies that have been vaguely outlined. So some of those are going to come to pass. Some of them are not going to come to pass. And then we have a whole bunch of other stuff that's happening around on the planet. And then you have the overlay of all these economic forces. So you have inflation rocketing downwards, but might also rocket back upwards. You have new technology and the new technology spend that is hyper accelerated out of the pandemic. And the potential, I think more so than historically, for more winners and more losers in some of these sectors, because there's so much that's changing, whether it's energy or it's biotech or it's SaaS/AI, and it's the effect of AI and Gen AI on basically every sector. I think we're at a particular period where it's harder and harder for people to say with certainty, this is what my business is going to look like in 3 years or in 4 years. I think at the same time, we've had this in the past, right? There are periods of volatility, and good business people and especially good M&A executives figure out how to play through it.
It's so interesting because I think, as you say, the word really seems to me to be uncertainty. If you generally feel like you have a sense of what business as usual looks like, I really wonder how you feel about that today. Do you have any predictions for what's coming up either in 2025 or the next couple of years? And what do you see as some of the opportunities and risks?
Sure. So I'd be a fool if I had lots of predictions because I think very few people, and certainly I haven't gathered the data to do a lot of like really rigorous analysis, but I have a couple of things that, especially just based on pattern recognition of having been around for up and down cycles, one is every time a new technology, and I think we can characterize AI, or at least the latest iteration of AI and Gen AI as being a new technology, comes around. My observation is, number one, you have a giant rush in, you have a lot of money wasted, a lot of pressure to just be part of the trend. And we saw this with blockchain, and we saw it back with the internet, and we saw it with BI tools in the early 90s. And that leads to a lot of wasted money, right? People who just say, let's just do AI as opposed to understanding use cases. And I feel like we're starting to get through that wave. And what I'm seeing shift in, which I think is a real positive, is a shift away from generic excitement about a technology, which usually I think is overblown, to what I'm much more excited about, which is particular use cases for a technology that solve very specific and well understood problems. And in my mind, that's always where I see new technologies really dig into the dirt and gain traction, is when you shift from, we just want to have AI so that we can say we have AI, to we have an AI tool that makes this process 12% more efficient, 14% less expensive, yields 30% higher customer satisfaction rates. It's that moment where I really believe in a technology. And I think we're starting to see that happen with AI and Gen AI. So I think the next couple of years are going to be an exciting period of, and this always happens with new technologies, the collision and merger of a deep understanding of the technology and a deep understanding of a particular vertical customer type problem. When those two things slam together, you get real great value creation, right? And we saw this all the way back in the internet, right? In the late 90s, there were a whole bunch of uses of the internet that turned out to be comically silly and unnecessary, and a whole bunch of money got burned, but it also yielded this amazing world we live in today. So I think that's one trend that I see happening in AI and Gen AI that's very exciting to me. I think the other one is a revisiting of the workplace, right? Which is happening right now. And I think has long running impact on just the way businesses are structured and operated, and whether that's contingent labor, in office, out of office, offshore, AI enabled labor, AR, VR powered labor. I think that's another big force that's gonna, and then I don't understand anything about it, but I see it happening. Healthcare and biotech, this crazy acceleration of ways that we make people healthier, which I think is fascinating. So that's the kind of stuff that I see happening almost regardless of the forces we were talking about earlier, right? Regardless of what happens in politics and global conflict and things like that, I think those things are going to just keep progressing because it's a little bit of a hopefully positive Pandora's box, right? Once the technology gets out there.
There's so much in that. I definitely am hearing what I characterize as specificity meets opportunity. I think that makes a lot of sense. And I'm assuming you're also talking about things like AI agents. The private sector, especially on the enterprise side, really agrees with you that instead of just the general applicability, people want to figure out what's the real ROI and are there business outcomes tied to this. Certainly, yeah. And I think
Quantified business outcomes.
healthcare is such a fascinating one because talk about a sector where I doubt anyone has any idea what's happening between the leaders that are expected to be at HHS and the CDC and CMS. Those are just massive amounts of change. So yeah, if you're interested in high risk environments, I think this is going to be the market for you.
That's true. Although to add some comfort, you have to believe one of two things about any major political change. And the first one is that it will be absolutely catastrophic in a permanent way, in which case, frankly, none of this matters and we all just need to start buying canned goods as quickly as possible. Or you believe that the system rights itself. And so the fundamental economic forces will ride out those changes. So I sort of, the way I think about the world is, regardless of what the federal government does or doesn't do in the next 4 years, the evolution of new drugs that attack obesity and a better understanding of the gut biome and all these new longevity tech are not going to stop happening regardless of what's happening in DC. And we're going to see them evolve. They may slow down or speed up or get shifted left or right based on policy. But again, the cat's sort of out of the bag on them. In the same way that I would say, I don't think I have to be a brilliant economist to say that whether or not there's a subsidy for EV vehicles at this point, it seems like EV vehicles are here to stay. I don't imagine a world where suddenly everyone stops buying them if the federal subsidies disappear. So I think that a lot of these really interesting business and technology trends, the road could be bumpier or lighter over the next 4 years, but they're going to happen regardless.
Yeah, and to your point, I think there's also a role for the states. It looks like California may actually step up if the federal government cuts back subsidies for electric vehicles. We're the largest auto market in the country, one of the largest in the world, and that has a huge effect. And also, California is where a lot of EVs have historically been bought. So one does wonder about how the applicability of such a powerful state with such a huge economy, like what the wider effect can be and where these waves meet each other, maybe.
Absolutely.
So in the ocean of regulatory policy, healthcare, our costs continue to increase. You and I are small business owners. We've been employees, both corporate and startup. We have a sense of what that looks like. It continues to be very expensive. Healthcare outcomes really haven't changed. There's a lot more PE money in healthcare. And at the same time, maybe there are going to be changes to federal policy around healthcare. And so I do wonder how all of that affects the wider question of just as a consumer and then as a participant on the business side, what that might look like. But
absolutely. And I think it gets even more complicated because I think all these healthcare issues are intertwined with broader cultural issues, societal issues of economic inequality. Healthcare is complicated enough and you can't even look at that in a bubble. Like a lot of people for different political topics like to compare the United States to tiny Nordic countries. And I think they're often missing the point that it's a totally different population with totally different dynamics. So it's not apples to apples. If I were a political scientist, the next 4 years are going to be a fascinating time to study all these different forces battling against each other and see what comes out of them. I think from a business perspective, you have to be aware of them, but you can't freeze in place like a deer in the headlights, right? You can't say the next 4 years look really volatile. I'm just going to opt out of acting and sit on my hands. Or if you do, you'll move behind your competitors.
No, certainly. If anything, it seems to me though that you probably do have to do more, need to have more breadth and variance in your strategic planning, I think, right? Instead of just these are the predictable outcomes, you really want to roll the dice, I assume, to see what might be possible because things that you would never have thought could happen may happen. At the same time, there are still some fundamental business challenges that need to be unraveled, one of them which we've talked about in our prior conversations, but valuations tend to be still very top of mind for a lot of firms, a lot of investors. They are still largely underwater given the prior growth at all costs era. I am curious, as you look at this macro environment and kind of the state of M&A, what do you think is going to actually happen? How do you think investors are going to try to address this problem of underwater valuations going forward?
I'll start with a broader context point, which is, I think you're absolutely right. This is a period of more unknowns. And I think as a general matter, the winners in these environments are people who have more agility and more creativity. So they're able to either A, pivot as the facts evolve, or B, design outcomes that work under multiple scenarios, because you don't know. Yeah, when you're in a rising tide, it's easy to make money. Everyone has to be trying to make money in all environments. On valuation, I think my view is we're going to continue to see, for different reasons, the weird dynamic we've seen over the past couple of years, where there's a lot of uncertainty around valuation and a lot of disparity of expectations around valuation. I think that over the past couple of years, it was in part driven by a huge spike in valuations, probably largely unearned, that was followed by a collapse. And as a general matter, I would argue, unless you're a finance professional, if you're an investment banker, you can view these things very calmly and independently and mathematically. Giant swings in valuation expectations are just part of the game. But I think for most of the people, certainly for founders and for owners and for corporates, it's hard to adjust, because if in your brain you anchor valuation to fundamentals, you then don't understand why the fundamentals don't change, but the valuation does change, right? You go, well, this car had 53,000 miles on it last week, and it has 53,002 miles on it this week. Why is it worth half as much? It's the same car. Unfortunately, that's the way the world works. So I think we've seen over the past couple of years a lot of frustration and disparity of what are these businesses really worth. I think that's going to continue in part as a hangover from that, because I still think we're there, right? If somebody tells you in 2021 that your company's worth $100 million, it takes a long time to forget.
We love a high water mark as humans, right? Earlier, you alluded to the fact that interest rates are very much top of mind, I think, for all of us, and it looks like we're going to get more interest rate cuts. How do you think that affects M&A? And do you think that we might return to another era of growth at all costs?
I think there's another force that interplays with interest rates right now and may swamp it, which is, I think we are going to be living in a world of haves and have-nots, where there's going to be a rush of money towards certain technologies and certain business models. And you always have a variance in valuations, but I think over the next couple of years, there's going to be a rush to, I wouldn't call it a rush to quality, but I'd call it a rush to something. And so that will push valuations in both directions. They'll go like that, even more so than they have in the past couple of years. Things like AI, things like certain parts of healthcare, all the money is going to be rushing towards them. Anytime money rushes towards something, valuations rocket upwards as there's more competition. I think that, yeah, interest rates coming down are going to free up a load of capital that is going to want higher returns and by definition will shift towards equity. That's a little bit of a rising tide force where it's going to put upward pressure on all things equity valuation. but I think it will be highly dispersed between different business models. So in some cases, you'll have a depressed valuation that maybe becomes 5% better because of that force. And on the other hand, you'll have hyped valuations that just keep rocketing upward. So I think in some ways, interest rates will bring more capital into the market. I think the other thing that'll bring more capital into the market, if it happens, and I have no idea if it will, is some sense of stability. If the market thinks that we are past any fears of a recession, past any fears of something catastrophic, like not all trade wars are damaging, but a damaging trade war, whatever else, World War III, if the market feels like we are past those things and on a steady upward trajectory, I think that will also free up a lot of capital, because people are putting money in debt for two reasons. One is because the interest rates were high, but another is because it's a nice safe haven while I figure out what the heck is going on. So I think I've figured out what is going on and I'm comfortable making medium-term bets will be a really powerful force that'll put more money towards equity.
And what if we end up in a trade war with our largest trading partners, Canada and Mexico? What do you think happens?
So I think it depends on what you mean by a trade war, right? If we're talking about relatively modest barriers that just increase prices a little bit and modestly increase inflation, then I think it has that effect. It's not nothing, but it's not going to fundamentally change the vibe of the M&A market. I think if we do whatever it is, whether it's a extreme trade war or something else, that in turn causes inflation to rocket upwards, then I think you'll see a pretty substantial downturn in M&A because, number one, if interest rates go up, then I've got another use of capital. Number two, now I don't know what's going on in the market. And so I want to keep dry powder and I'm hesitant to make bets. I think all those same forces will hit. I have no idea what the line is between a digestible trade war and a disruptive or damaging or extreme trade war, but I know there's a spectrum.
So I'm curious, if consumer prices continue to increase, do you think that has an effect on M&A and deal flow in general?
I think it does, but it's ancillary, right? Because consumer prices going up, inflation going up, that also can cause interest rates to go up. So that might pull capital from equity and it might slow consumer spending, which might affect some sectors, but it might not affect other sectors. So I think it becomes industry sector by industry sector and also stage by stage. I'm not an early stage VC, but my guess is that their time horizons are long enough that they can look past some of this stuff, right? If they think they're investing in something that's going to disrupt the world with a new quantum technology in 10 years, consumer prices over the next 3-4 years can't be that much of a relevant variable to them, right? They're not only looking far ahead, but they're also looking at something that is such a gigantic bet that it'll either work or it won't work. If it doesn't work, it doesn't matter. And if it does work, it doesn't matter, right? If I think I'm creating a teleporter, it doesn't matter what the inflation rate is.
Speaking of capital sitting on the sidelines, something to the north of $2.1 trillion in dry powder is sitting on the sidelines. This is as of September, and that data comes from BCG. So to your point, if interest rates continue to decline, one assumes there is even more money in the market. That is a crazy amount of money. That's my unscientific language around that. And it encompasses PE business models across a spectrum of different types of business models, right? From leveraged buyouts to growth equity. How do you think about the volume of capital and the variety of business models within PE? How does that affect M&A?
The obvious answer is whenever there's a lot of dry powder and a decision is made to release it, it ramps up M&A. And in a number of different ways, in terms of volume, in terms of deal size. If you need to deploy large amounts of capital, it's easier to do large deals than it is to do small deals. So it has all of these different force effects. Now, I don't think just because there is dry powder, it's going to be used, right? That gets to the earlier conversation we had is you've got to have lots of dry powder. You've got to have no super attractive alternatives, right? So interest rates are not 10, 12% where you can just get zero risk returns that are attractive. And you have to have a risk tolerance level that's fairly high. So you've got to believe the world isn't about to end and my money in equity assets is going to be safe. If we get to that sort of trifecta, I think you'll see a lot of capital pouring out into the market. I think it'll increase average deal size. It'll increase volume of deals. It'll increase valuations. And I think what I always find interesting is how wide a divergence you can have. And obviously hindsight is 2020 between really good uses of capital and really bad uses of capital. We all remember from every super strong market, a deal that looks absolutely brilliant in retrospect and a deal that looks absolutely moronic in retrospect. And in my experience, the more money the more money floods into the market at the same time, the more you skew to moronic deals. In part because there's just an adverse incentive problem, right? If you have a hammer, everything's a nail. If you are a capital allocator, your job is to allocate capital and you will look for places to do it. And I also think there's a weird FOMO thing that happens where when there's a rush of capital in any particular direction, everyone wants to make sure they're not the person who 5 years from now didn't go into the Series A at Google.
It's so interesting. I know you're really interested in the psychology of deal making and M&A. We came out of a 15-year period of growth at all costs, cheap, easy money. We went through COVID, and now we've had a couple years post-COVID that have been tighter. Obviously, one would argue that had a lot of effect on elections around the world this year too. So, given that, do you think that because some of those tougher years are a little bit more fresh versus that prior 15-year period, do you think that has an effect on competitive bidding? I also don't think that anyone wants to be the last money in on a bad deal that just never gets taken care of. These are smart people with a lot of money. Nobody wants that seat at the table either.
As somebody who's now in his mid-50s, I've seen this movie before. So yeah, people learn from their mistakes, but nobody can resist the rush and the enthusiasm of a hot market. Unfortunately, I think we're doomed to repeat ourselves to a substantial extent. Now, different people will make the new mistake. So maybe the same person won't make the same mistake twice or three times, but there's always a new crop of people to make those mistakes, right? One of the data points, I forget the actual percentage, but some incredibly high percentage of current capital allocators, people who run hedge funds, private equity, portfolio managers, at least at the mid-level, have never experienced a proper down market. Because the last real down market was 2008. And that was 16 years ago. There are a whole bunch of those people who were in high school at the time. High school.
Nobody on this call, but I know what you mean.
I think there's two forces. On the one hand, three forces. On the one hand, everyone remembers 2021. It wasn't that long ago. On the other hand, the FOMO aspect, fear of missing out aspect of some of these new opportunities is going to be too great for people to sit it out, and they'll talk themselves into believing this is different. And then the third force, which I'm waiting to see creep in, but I think it may take another couple of years, is the vintage 2020 and 2021 investments are going to turn out badly, right? Not uniformly. There were some great ones, but those vintages are going to be tough vintages. And so obviously for hedge funds, they know that because they mark to market. But for private equity and venture capital, I think those chickens are still coming home to roost. And so people will watch that happen, and that'll reinforce the lesson of be careful of accepting whatever the current market valuation is in a super hot market, because you want to be in there.
Thanks for joining us. This was the first half of our conversation with Michael Frankel. We'll see you here next week for the second installment. Thanks so much for listening to Good Revenue. If you liked what you heard, please subscribe to the show, give us a rating, or leave us a review. It helps other listeners find us, and we really appreciate your support. You can also catch full videos and highlights on our YouTube channel.